Alright guys, glad to have you on board again today. I promised this one in the regular weekly updates and therefore I'm going to deliver right now. The idea here is to make a long-term forecast briefing because what we're going to be discussing today is really about kind of long-term investment strategies for those who have management portfolios or whatever thing like that. It's definitely not suitable for those who are short-term trading, arbitraging or any other stuff like that. So we're definitely not doing anything below like monthly charts or whatever in these kinds of reviews. What we're going to be dealing with in here is like long-term cyclical portfolio exposition, strategies, things to do, not to do, areas to avoid, and things to eventually forecast. So of course, as a kind of preliminary introduction, I would reiterate the initial statement that you probably are familiar with. I don't know anything about the future. I never did, never will, and no one else ever had succeeded into doing such a thing. It's all about just risk managing, is trying to put as much efforts and rational thinking in your processes and replicate them consistently over time. So the idea here is to use well-proven models and all sorts of things, and just once again understand that a model is nothing but a model. It's just better than just random kind of arbitraging. So it's really the way to go. So many people have ideas on what they think about what the market is about to do or whatever. I do have mine. The idea is to have them anchored into as realistically plotted as possible kinds of modeling that have proven their efficiency through time, essentially proven the test of time. So this is what it is. Though among the models that I've been using, there's a combination of two that you might be familiar with. There are the reasons why I am very cautious about the market for the last 6 months is the combination of the ECM, Economic Confidence Model from Martin Armstrong, which is a pretty damn kind of genius, very well misunderstood as well. But once again, geniuses have their own backlash. But nevertheless, this thing is real genius. So don't take it all from Armstrong. Just I sincerely think the ECM is the best to take away from it because it has proven over time to be damn fucking efficient. So that's really the way to go. I don't want you to get anywhere beyond that. Remember that this guy has a lot of things that go on. It's really not really worth it, but this thing really is worth it. So what it says is that we're supposed to terminate something that is supposed to be the commodity boom by the end of 2024 that would have triggered out of all by itself the next cycle, which is a contracting cycle where the economic confidence is degrading through time by 2024 up to 2028, and it's essentially leading to an authoritarian peak. Okay, so that's basically what we're expecting to see now. So we're expecting a commodity boom that leads us to an authoritarian bust. Okay, and that's pretty much what it is: booms and busts and economic cycles with investor confidence in the middle of it, which is just driving prices upward or downward. It's really the way to go. There is a kind of an intermediate cyclicity to these cycles, which is something that I take in here with a little bit of a grain of salt because it's definitely much more like precise oriented stuff when the market's generally not liking these kinds of things, but just bear that one in mind. So it was supposed to be somewhere like May 2024 to build the actual market up until the first cycle, which is supposed to terminate by June next year. And this first cycle is expected to be one with the strongest momentum in the overall consolidation. Of course, the most dangerous one then being the pi cycle, which is very violent in a much shorter period of time. Okay, so that's really the way to go. Understand these kinds of things. I've replicated these throughout the chart so you can easily see them. All right, the second thing is the Dalio kind of longer term model to try figuring out that out of the ECM says the peak is supposed to happen in the West in late 2032, so basically 2033. 0.95 is essentially 23. So peak in West as the market is supposed to shift its confidence model through China in 2037. Okay, so that's basically the way it is. It's confirming and converging with the Dalio model in which China is rising and the US is falling in their long-term kind of dominance model. So of course, remember that Dalio himself says that there's no way you can escape the downturn when you had the upside. There's no way the upside is guaranteed so long as you don't, but it is so long as you follow the kind of path. So you see China having its first dead bubble, but don't get it wrong, there's going to be another one. Just like in the US, you've seen the first dead bust in 2008, and the other ones have followed suit and will definitely follow as well. Revolution and wars are to be expected at some point, and so on. So these are the things you need to understand as we get closer and closer to this kind of shift, which is expected to happen in the 2030 kind of decade. So not now, but we're getting closer to it. So the pressure is in a kind of confluence where the cycles are going bearish in here in a confidence model. That means some of the confidence is likely shifting to China. So that's really the way to go. As US is expected to contract, some of this attention might be eventually going into China, as China is still rising where the US is somewhat contracting. And remember, the capital is something that flows from one area to another. So I expect this to fuel the demand for China and other emerging markets that have been heavily contracted lately as the US regains strength in somewhat of a degrading cycle. So it feels pretty counterintuitive to see the US kind of heading towards supremacy when they're actually degrading. But that's the world we live in, hence the reason why I am a bit kind of contrarian. So remember, these are the S&P cycle. So the cycle, major cycle bottom is expected to happen in 2028, following a set of intermediary cycle where a first bottom should happen somewhere around June 2025, followed by a kind of upward cycle in which the confidence is supposed to raise a bit, but not making new highs, until at the end of this thing another cycle bottom happens, and the pi cycle is the worst that's supposed to get to the end of it. And then of course the major cycle bottom happens. So of course, remember, these are just like guidelines that just give you a head start in the market potential timings. Timing the market is something you should never consider doing. So that's really the way to go, okay? What that tells us is that we're 6 months late already as we keep grinding through a cycle that was supposed to be the peak. So we're late to the cycle, and we still have, I would say, 6 months to go. But remember, we can go up for 6 months and then go down for 6 months much more violently. And this would have been the equivalent of just contracting for 12 months. So what I'm trying to say is that if this is the path predicted by the model, if we decide to do this, that means we're going to do violent kind of reversal to go exactly anyway to the same point B. The idea here is that we don't necessarily need to go much, much lower because of the underlying fundamentals that we have highlighted for quite some time. Is that it is not just about S&P 500 valuation globally, it's about the overall market structure. We're in a trend. The trend has been overly bullish at the end of it, fueled essentially by inflation. So the idea here is we would like to divide the S&P 500 with that inflation, and you would see this chart, which is essentially S&P 500 divided by the net inflation. And you would see that in here, the overvaluations gets pretty much removed. And what we have in here is a very much kind of a big fucking range, which is the kind of lost decade in the markets, followed by a new trend, which has failed so far to create an actual pullback, which means we fail in here to create a mature range. We have kind of consolidated, but not long enough to actually close below the context at the context closure. We've closed somewhat at the median, not below. So I think this is what we're ahead of. This would definitely be following the divergent kind of pattern, which means we're trying to trade above the resistant context. And we will potentially fail in here. We have all evidence that all the signals are here for a divergence pattern, which is supposed to consolidate. Which means out of this, we should now finally get to close below the 50% context. Sustainably, we're probably going to reverse the context in the process, create a mature range, which means we're going to have to spend time here. And remember what we said, mid-2028 is the expected time in which confidence has bottomed, and we should be ready to go all-time high again. So if you follow that kind of guideline, that tells us one thing, that the range is going to last for nearly 4 years now, and there's no way we can get back up until the long-term targets of 2033. And by 2033, we should be building a major peak in West. Okay? So that's the reason why I think that some other smart kind of investors have said we're probably in a lost decade already, in a sense that the general grand scheme of market valuation is probably going to be ranging in the nearby area for almost a decade, starting of course in 2021 and potentially not reinstating true legitimate value increase in the bull market until 2030 or so, up until 2033, which is expected to be the market top. Okay, so that would be consistent with a classical kind of range, pullback, which is a range, and then final excess, which means this is a range that we're going to break to the upside. Okay, it's a range which we're going to positively get rid of. It's not the end of the world. We're not going to kind of crash or whatever. So, oh, sorry, the doom and gloomers, I don't nearly believe you are right. I think you might be proven right for some time by a consolidation, which you're obviously going to take as the bear market crash, whatever shit, but it doesn't feel to me like it. It's the kind of bear market that I would like to buy. First and foremost, there are all the fundamentals at play in here, the ones that we have mentioned quite a lot of times. There is disparity within the S&P 500 that leads to me that the S&P globally is going to contract, but not necessarily destroy everything in the process, because we have enormous concentration of a handful of names. The RSP-SPY ratio is extremely low, leading me to believe that these overvaluation in the big tech stocks and the bubble we have in the AI mania is likely going to burst, and the latter and the former is probably going to contract, which means the overvaluations in the tech sector are more likely going to consolidate, not crash, but the bubble in the AI mania is likely due for potentially crashing, as we're definitely in a kind of typical phase in here where the model basically says sorry, not this one. Yeah, but we're at the peak of hype. It's basically inflated expectation for coming from the true legitimate adoption of AI. And don't get me wrong, AI is definitely going to be here to last, but it's not going to change your world today. It's probably going to do in the following decade, not now. But they're definitely selling it to you today at a fucking premium. So that's the way to go. The second thing is that we've seen an outrageous arbitrage between value and growth, which is normally technically assessed by being a contrarian trade to be making here. Essentially, don't follow the growth narrative. You want to buy the value instead. That means in this kind of range, it's mostly buy the value, sell the growth. So when you're at the top of the range, sell the growth. When you're at the bottom of the range, buy the value. And that's really the way to go. So that's really how it is now. The thing is that we've pushed that kind of narrative very much in the stupid lines, where the value is definitely underperforming the market for quite some time now. It's been lasting for nearly 6 to 7 years now. And we're into the process of where I think is actually buying value and selling growth as an arbitrage. The second thing, as we've seen, is the arbitrage of China to the US is essentially in here we have everything suggesting we had a bearish range, which means we're actually selling inside the context. And we have taken profits below the actual support context. And you have seen in here, even though that would be pretty much in a quality-based kind of scheme, we've definitely have reached the potential market top, market bottom. So we're in areas in which it doesn't make any more sense to be bearish for China. So the idea is we're probably going to replicate the kind of system which you have 2 bearish legs followed by 2 bullish consecutive legs, which is likely going to build a big, massive kind of range. But expect that the second leg in here, which is going to invalidate the kind of US dominance, is potentially not going to happen until 2033 and 2037, which is the sign in which normally everybody should understand the shift to China. So my hunch is, in terms of global cyclicity, all that we can get in here is just invalidating the bearishness. That means getting to reverse the context and close above it. So we need to get up here and close in this area. This would be the sign to me that I am the right narrative. That means China is really going to take over the world. And remember, that's just a model. I could be wrong with that. So that's the thing I would like to see for this to confirm my assumption, and following with that pattern as we go along. So for now on, that says the same thing. That means if you want to sell the US, you don't want to be a net sell short of the US. It would be way too dangerous to do such a thing, just like the Buffetts and the like of this world are actually not necessarily selling the S&P 500 today. They're just getting rid of overvalued stocks. They're releasing and taking their profits on the apples and the like. And that's exactly what I think is the best kind of strategy to make. If you've been a bull into the growth sector, take your fucking profits off the table. That's just the way to go. If you've been trading the bubbles, the Nvidias and the like, well, eventually try to ride that bubble, but when it reverses, it will do just one time. Get the fuck out of here. If it reverses, it's going to be a bloodbath. And the last but not least, if you want to invest, maybe invest into smaller, less fancy kind of companies who can actually deliver dividends or whatever, so that throughout the potential next 5 to 6 years, which is expected to be a lost kind of period in the market, expect to find dividends or whatever that can actually at least cover for the inflations that are going to be rampant in this system. Because remember what we've seen, if you look at the yield curve, a recession is coming along the way. And if that recession hits, there's not going to be any actual financial support by reducing yield, being essentially due to the fact that the Federal Reserve is locked into an embrace where there's going to be inflation. And it's visible by the longer end of the yield curve that you see here, which is clearly tainted like, yeah, we're going to stay there for quite some time, folks. We're squeezing the momentum. So don't get me wrong, we're going to stay there for longer than you think. Just pretty much as we did last time. So we're going to stay there. That's what it says. It says the longer end of the yield curve, the one that is actually fueling real world costs, like your mortgages and the like, will remain elevated. The short-term yield, aka cost of capital, we're going to have to be going into supportive territory, but the support isn't going to come from the Fed this time around. It's probably going to come from the government spending, and this will fuel inflation. So that's really the way to go, is to say stagflation, moderate stagflation is what we're headed to. The reason why I think it's definitely inevitable is because other ratios are actually forecasting this as well. The first and foremost ratio you need to be aware of is this one, the USD WTI ratio, printed out over 50 years plus, okay? It definitely tells you, well, boy, if you think this thing is a trend, good luck with that. Yet now I see people telling me that we're in exceptionally favorable condition to buy stocks, whatever the fuck they're saying. I don't get any point of it, because we're like so historically stupidly low in this range that it would be just as stupid as saying, yeah, buy this kind of chart when you're right here. Like, yeah, of course, WTI prices are going to keep rising. No, of course not. You want to be a bear in here, because other people are just painfully going to be proven wrong in a very volatile way. So just like as you see, when we go from one end of the spectrum to the other, it's generally very violent, okay? So that's what you need to understand, okay? It's always with violence that this thing goes from bull to bear. You would see that this market has kind of cycles. It has a moment in which this trades at a relatively elevated level, then relatively low level, then relatively elevated again, and relatively low again. So expect the next area to be elevated cost of oil against the cost of capital. Okay, that's just a ratio some way. So we're in the bottom of it for quite some time now, and people still tend to believe that we're going to go further away. I think we're like right in here. This is about to happen, and this is going to be violent. And we're talking about quite a ratio. We're talking about multiplying it by 3, and that's not nothing. So if we are about to multiply the cost of oil to the cost of capital, aka in here XAUUSD, it's essentially going to mean a 3x ratio between the two. And if you look at gold, you would see, oh boy, this big boy is trending and has been breaking a cup and handle pattern, which we have forecasted for quite some time, and we're nearing the targets more than the other way. So once again, be bullish on gold? Yeah, not to me. Being bullish on gold already is the way to be, but is it about time now to take your profits? Could go higher? Yes, but the idea is if gold can still go a bit higher, and if it doesn't, well, there is a lot of consolidation that's going to happen. But as you can see, it's never going to be enough to multiply the other ratio by 2. So that means whether you like it or not, I think oil prices are going to rise. And when we look at the oil price in here, we've seen that we have a weekly flow pattern that is potentially playing, which means if we build a bottom out of this moving average in the weekly chart, we're probably going to have sustained flow of capital into this trade, which is going to push it higher. The targets will be to break the previous high point, which is 130. So that means this is where we go. This is where we find the actual 3x multiplier by both contracting in the dollar, which is, in the gold, which is generally not a sign of dollar strength, but a sign of recession. Remember that gold always peaks before recession. It goes up, and then when it goes down, it's the sign of recession. That means people need capital to support as the economy contracts. So just like I think people are storing their wealth in gold, they're going to take it away when the recession is going to hit. And it's going to be doubled down by the fact that infrastructure costs, like base mechanical cost of producing, which is directly tied to the cost of oil, is to me going to increase over time. And that's what's going to lock the US in stagflation. Increased cost of producing while reducing cost of capital isn't going to be efficient because of the stagflationary environment which they're in, which means the Fed can support. The money is going to come from the private sector. People are going to take away their money and gains from the well-owned trades in gold and whatever. They're going to get rid of their speculative assets, which are traded with overvaluations. Not necessarily to get rid of it forever, but just like Warren Buffett is doing, getting rid of 2/3 of its actual apple pies. It's really the way to go. Get rid of it. It's just the way to go. You might be able to buy it at a cheaper price later. So lock on your well-known gains instead of waiting until they collapse. The other ratio that also supports that thesis is this silver to gold ratio. If you look at it in the distance, as well in here, 50 years of history, you would see that we haven't really been traded at that kind of ratio for a very long time. we've always in here have rebounced, and whenever this ratio gets very elevated, where I think we're going, that's generally the sign of these kinds of stagflationary predominant environment, that like the late 60s up to the 80s. These are environments in which stagflation is generally the kind of motive for consolidation. Remember, there are multiple times of recessions. There are deflationary recessions. That's the one we have in here. If we go for a stagflationary recession, we're going to quickly go up here. So there's a reason why I expect silver to gold to explode. And God knows that JP Morgan and other market makers in the US have been manipulating silver prices for quite some fucking time. It's really documented. No tinfoil hats here. It's just really the way to go. So if these guys gets invalidated, it's not going to be pretty, and silver to gold ratio might explode. So we'll see all of this, but these are the kind of fundamental metrics that would support my thesis to be proven right or wrong. If you see the cost of oil against the cost of gold essentially skyrocketing, that would be the sign to me that we have gone to an extreme and that we're changing the market mood. Just like if silver to gold ratio were to skyrocket, and history proves that these things tend to pop very, very fast. So I expect something to break it. I don't know, but something fundamental. Like, I don't know, a real world catalyst or whatever thing like that is probably going to be causing this reversal. The reality is that we're already 6 months late in terms of actual S&P 500 reaction. That's all there is. Okay, I think what we need to pay attention to is not necessarily the relative S&P 500 prices, but the S&P divided by CPI, which is going to give us the top. For now on, same kind of 6 month delay. It can either happen fast, that means either the S&P stagnates, but the CPI skyrockets, which is going to bring that ratio down, or both, like the CPI slightly rises, but the S&P start to slightly contract. I don't think it's going to crash out of nowhere, but just I think a market top could start to build itself. So we're really 6 months late. The first cycle is supposed to terminate 6 months away from now, or 7 months in June next year. So that's going to be my first time invalidation. If somewhere around like May or June next year nothing has happened yet, that will be the sign to me that the market is in another stance. Either this is like bubble to infinity or whatever, but clearly that will be a sign that the cyclicity pattern that I've been using are simply not playing through. The other thing, like I said, would be invalidation on the ratio charts that I have presented, SPY, IVW to IVE, ratio chart against China, ratio chart against CPI, ratio chart between WTI and gold, ratio chart between silver and gold. If all of these were to invalidate, that would be the sign to me that I'm definitely not in the right train. Now, when it comes to crypto, I'm quickly going to roll over to this sector because I definitely think there is absolutely similar kinds of patterns being at play in here. We see the exact same kind of things, but replicated in somewhat of a crypto fashion. So we've seen stupid value to growth arbitrage to the kind of Solana to Ethereum, which to me, well, like I said, we've reviewed this each and every week. Ethereum has the most solid fundamentals of all. It's just, to me, the big elephant in the room that we need to tackle. There's no bull market to me without Ethereum. And as this one hasn't broken all-time highs, there's no way this thing actually gets to be sustained durably. The fact that we have finally sent a message that we could break the final Bitcoin dominance. Remember, Bitcoin is the only one that has sustained inflow now, just similar to gold, but that might be for the wrong reasons. People might have gone into Bitcoin because they fear of recession. And if Bitcoin starts to go down with the dominance, it might be the sign once again that the market should rotate to value and away from the handful of names that are overcrowded now. All the meme coin, shitcoin stuff, all the Dogecoin or whatever thing that has absolute no utility. These are just like the AI bubble to me. Like Dogecoins would go bust absolutely. Now there is the growth ratio, kind of the tech stocks. That would be the equivalent to Solana. They are actually valuable stuff. Remember, I may dislike Solana and sometimes speak very badly about it, but the reality is Solana is here to stay, whether you like it or not. And I never said any different than that. But the thing is that right now, just like Apple is here to stay and Amazon and the like, they're freakingly overvalued. They don't deliver on the cash flows and they will not sustain these valuations. So I think growth has to cool down. Just I think Solana has to go down faster than ETH will ever. Just like ETH is a value, so if it goes down, it will not go down that much. So I want to see the SOL to ETH ratio going down, and that's exactly what it's starting to do. On the other hand, the kind of Ripple to ETH ratio, I want to see them crash out of nowhere because Ripple serves absolutely no purpose. It's really a shit coin. It's really the way to go. Though, if you kind of want to prove me wrong because you're XRP army or whatever, good luck with that. So that's really the way to go. We can disagree on that. Like I said, you might have your own opinions. I have mine. One thing for sure is I'm selling short out of your asses. So that's really the way to go. Just like I said, I think right now the trade is to arbitrage portfolio exposition to favor out of the big tech stocks or eventually even selling them. Now, if you are selling them, what you want to be doing is selling with a spread, which means buying China. I'm selling US tech stocks, the Apples, the Nvidias, the Teslas, but I'm buying the Babas, the Pinduoduos, the Xiaomis and the like. And by doing this, essentially what it does, it's been providing some significant gains so far, because nevertheless, these guys haven't been consolidating, but these boys have skyrocketed a bit lately. So that's really the way to go. I think doing the arbitrage is the way to play. Don't try to be a directional kind of trader, like either just buying China and doing nothing else, or just trying to sell against in the US. That would be very dangerous. On the other hand, buying the kind of growth or whatever stupid narrative in the US is just so freakingly dangerous. Because if you do this, you're essentially buying a market type that will never be reached out in the years to come. That's the message sent out there, folks. By looking at it in a diluted manner, you would figure out that the S&P is going for a pullback. That's going to necessarily last for a long time. It's going to last for years until you eventually get back to your actual valuation thresholds. If you buy it now, you're probably not going to get made whole until at least 6 to 7 years or 5 to 6 years. And you might suffer some very painful monetary dilution in the process, on top of your stocks going down. So that's very much, to me, a big, big problem. So that's the way to go. The other thing, like I said, get the fuck out of the bubble of Nvidias and the like. They've reached their targets. Take your profits. At least secure your profits. And if they start going down, get the hell out of here. Don't hold on these kinds of assets. When they'll go down, they'll lose 60 to 70%. That's the same thing for the shit coins that have pumped out of nowhere. They're just showing their illiquidity. Get the fuck out of here before it goes down. And if it does start to go down, don't buy the dip. Get the fuck out of here before it's too late. And don't get me wrong, when these kinds of things weight hundreds of billions of market valuation, there's not enough money. So there's not enough chairs for everyone to sit on. So the money you think you have in the account will smash and disappear instantly when the thing go bust. So be very cautious with that. The valuations are stratospherically stupid, and there clearly isn't enough money for everyone to get out. So they're just showing how centralized these things are. They're just non-actual circulating supply. They're pump and dump schemes. Be very cautious with that. Just like the bubbles go back down to earth in a violent fashion and they never recover, I think that's exactly what's about to happen. So be very cautious with it. Get away from AI. Get away from speculative meme coin shitcoinery in the crypto sector. Don't follow the narrative. It's way too late. Get out of here before it's too late. If you want to play, if you have played the growth narrative, it's about time as well to get the fuck out of here. And if you don't know what to do, and if you fear of the market pumping higher forever, eventually just rotate Solana to ETH. It's just the safest bet to do now. That means if both of them are going higher because of the bubble, whatever, you might still make a lot of money by buying ETH. So that's really the way to go. But going into the growth narrative and forgetting about value, I think clearly we have gone to some stupid valuations. To me, the trigger is at some point in time, Solana was worth 30% of Ethereum. There's no way and there's no world in which that is sustainable. So that's the way to go. Same thing for Ripple, just saying so. I'm short selling your asses, guys, just because, well, you're currently weighting 34% of Ethereum's market cap, and I think you're not even worth 3 to 5. So that's really the way to go. You'll see, we'll see, but that's the way to go. Okay, so right now be very cautious. Favor arbitrage strategy rather than directional side of stuff. We're really in a dangerous corner of the market in which some people think the bubble is going to go even more stupid and that we're just getting started and that you need to buy AI, whatever shit like that. And there's the rest of the market, which is, yeah, maybe not. We're maybe ahead of a lost decade. And both the Warren Buffetts, the Michael Burrys, and all of these kinds of well-renowned historical investors are all flashing red signals all over the place. So be very cautious with that. That doesn't mean the entire market go down. That means it's about time to change the strategy. Get out of passive investing, because if you buy in just the S&P 500, you might get diluted for 6 years. And you might not be made whole until years to come. So buying now, not really a fancy kind of stuff. Mostly you're buying a heavily concentrated S&P 500. So actually you could still make some money if you're smart enough to buy more into the value end of the spectrum rather than the growth. You might be made whole faster if you're actually waiting for more attractive prices and if you try to get away from the bubble that there is. And clearly there has been an unproductive bubble lately in the crypto sector, stupid tokens pumping for no reasons. And on the other hand, in the stock market, it's essentially pricing some stocks at outrageously high valuations. And I'm not just talking about kind of Nvidia, I'm also talking about all the AI shitstorm that have been making stupid valuation and stupid PE ratios on companies just because they're using AI. So be very cautious with that. There is definitely an AI bubble with overinflated expectations and crazily high overvaluation thresholds. So be very cautious with that. These kinds of things will go bust. It's a bubble burst that's going to happen when it comes to AI. And like I said, AI itself as a technology is going to potentially survive it. I personally almost guarantee it will. But the thing is that what you guys are buying into now is hype. And hype isn't going to make you whole for nearly 20 years. So be very cautious with that. Growth may happen, but most of the momentum stocks that you've been buying into now may not even survive. So that's really the way to go. Be very cautious with that. I'm going to leave you guys with that. Trade safe. Try to be rational. Try to understand that you need to be picky now in the market. Don't go with the indices. Don't buy into the shitstorms. Don't buy into the crowded names. At least get out of them. If you want to gamble, gamble. But gamble with a stop loss, because when these things start to go down, it's a bloodbath. And there's clearly not going to be enough room for everyone to get out. So that's it. I'm going to leave you guys with that. Bye-bye.